Welcome, everybody. This presentation is all about fair value gaps. We will be exploring beginner and advanced understandings behind the FVG ICT concept. I would like to firstly note almost everything in this video is directly from ICT himself. However, there are a few notes and understandings I have come across from my own personal experience that I have included in here. These are the topics we will be discussing and going over in the video, and as the video goes on, the understandings and teachings will get more and more advanced. Okay, so firstly, what does a fair value gap look like? A fair value gap is formed within a three-candle pattern as shown in the diagrams. We have a bullish FVG and a bearish FVG. To correctly identify the fair value gap pattern, we must look for a gap in price delivery between the first candle's high and the third candle's low. If the two wicks represented in this image do not touch one another, we have ourselves a fair value gap. Same can be said for the bearish example. It is important to note that not every single FVG is useful for you in price, as we look at in later slides. Next, we ask ourselves, what is a fair value gap, and what purpose does it serve? A fair value gap is referred to as an area of imbalance in price delivery. This can happen when one side of the market liquidity is offered but not the other. This imbalance is confirmed and shown by the existence of a fair value gap. Fair value gaps can be visible and used from all time frames and thus are a very versatile PD array. Fair value gaps are one of the most common PD arrays within ICT's PD array matrix. Provides insights into areas where price may return for optimal entry or exit points. Here are a few clean examples of fair value gaps being drawn out and used in price. As a tip, if we combine any FVGs that we see with an available volume imbalance, this gives a more simplistic drawing on the market to identify similar gaps. If we now zoom into how we can use the FVG to improve the precision of lower time frame entries, we will see that they permit better overall trade management and risk. As once you are clear the draw on liquidity, you can confidently rely on inefficiencies to hold in price. You must make sure that you are flicking through all of the available time frames to compare different inefficiencies in order to get a clearer market read on price. Higher time frame bias plus narrative, and confirming institutional order flow. We can see in this image that price has left a large inefficiency in price. Once price touches into this higher time frame FVG, and respects CE, there will be more on this later, we displace lower, creating another FVG in price. This gives us our framework and a higher confirmation that our bearish bias is correct. Once we touch back into the second FVG, this is a high probability zone for sells. Notice how the bodies of the candles did not even close within our FVG area, showing respect to our bearish PD array. Upon creation of that second FVG, we can be confident in institutional order flow being bearish, and because price is fractal, we can use a lower time frame entry to trade towards the lows. Similar to the last slide, we can use FVGs as a higher time frame point of interest. Typically, you would look at the 15-minute to the 4H time frame for intraday points of interest. The market is very fractal in nature, and thus we can see signatures in price of these gaps being respected in every single time frame. On this slide, we will take a look at another example of where price has touched into a 4H bullish imbalance. This becomes our point of interest for the day as we expect price to drive higher from this PD array. Once we drop down into the lower time frames, we can clearly see that after respecting the 4H gap, we create a displacement and a 5-minute new gap. This area and reaction in price gives us confirmation and confidence that price should seek higher prices. Creations of the FVG confirm speed within the market. This is practical because we can then look for them to confirm market directional moves or potential reversals. In this example, we create a 2022 market structure shift model because price closes below the low with the creation of fair value gaps. This gives us more confidence in the structure shift as opposed to it being a liquidity sweep or a Judas swing. Fair value gaps can also be used as take-profit objectives. Typically, we will see highs and lows as liquidity targets. However, to more accurately pin prices, potential target locations, we should look for the nearest next open fair value gap in price after the high or low is swept. For example, if we sweep a 4H low, we should drop between the time frames of the 4-hour, 1-hour, 15-minute to find an open gap resting below, as shown in the screenshot. There are so many different types and versions of the fair value gap concept, and these will be covered in separate videos as they get more advanced. Let's talk about the inverse function briefly of the fair value gap concept. This occurs when price closes back above or below an existing gap. We can then use the area of the gap as reasonable support or resistance in aiding price's continuation after the reversal. The best times this occurs is once an important pool of liquidity has been swept, so either a session or daily high and low. Price should perform a sharp and energetic displacement back through the fair value gap for a higher probability scenario. These are a few good examples of inverse functions being used to support price's reversal direction. Trade management. The basic guidance on how to incorporate this concept into your trade management is to place your entry on either the high of the FVG for a long or the low of the FVG for a sell. The first presented fair value gap is a fairly recent concept discussed by ICT, where we look for the first fair value gap that forms after 9:31 and between 10 a.m. This will then help to set the tone and bias for the early trading session. I personally do not find an incredible amount of use in this concept myself. However, it is still valid and can be useful. Therefore, I'm going to continue through the slides we have left, but if you would like to know more about how to use them, pause the video here and read more about it yourself. Gap theory is a deeper understanding of how the algorithm looks at price levels and respects them. The levels we will look at are the 25, 50, and the 75%. To visually see these levels, we typically draw a Fibonacci tool inside of the fair value gap box and monitor how price touches and closes around these levels. Gap theory can be applied to all the different types of gaps in price. However, we will only be focusing on the FVG's usage. Candle closures that respect the 25% upper range of the gap display a stronger market overall, and thus we expect for the 50% level to hold candle body closures. On this slide, we have a higher time frame fair value gap drawn out, and we are monitoring how the lower time frame reacts to the levels inside of its structure. The 25% level was subsequently respected, and price then seeked lower targets. On the right, we have an example where price barely fills in any of the imbalance. Once it touches the gaps area, we have an immediate reaction higher. This is called an institutional order flow entry drill. It's useful to be aware of these signatures, as this shows strong willingness for price to continue higher. If a fair value gap overlaps with another PD array, this provides a higher probability point of interest. This means that if you can correctly identify the open of an order block or breaker block that overlaps with a FVG, you should adjust your entry or market bias, as it's very likely the market will return to these price levels. Here we have different examples of price reacting to PD arrays that overlap with our FVG. Let's discuss an advanced power of 3 concept within the fair value gap structure. This matters because the candle structure that forms the FVG is a result of the lower time frame pattern. On the left example, we can see that the fair value gap structure has 3 candles of distribution. This means that for the following candles, we can expect a continuation in market delivery. However, on the right, we can visually see that the third candle has created a lower time frame consolidation. The importance of the pattern is because we understand the probabilities when coupling the power of 3 concept with the AMD concept. As the fourth candle opens, we can reasonably suspect that because the third candle's close is below the second candle's high and has created a lower time frame fractal AMD pattern, that the fourth candle should sweep the lows into the FVG, creating the Judas swing, before continuing with the displacement higher. And finally, the icing on the cake is some fundamentals I have personally found as to why I think partly the reason fair value gaps work in the first place. As we know, price seeks market liquidity both below and above, when we enter inside of a 15-minute fair value gap, we know that on the lower time frame, that FVG's candle low is a significant internal swing low. This means that whenever you enter inside of a fair value gap on the lower time frame, you're just performing a turtle soup entry. I hope that is some food for thought. So what did we learn in this presentation? That fair value gaps are an extremely versatile PD array. They are better used alongside other key fundamental PD arrays such as order blocks and breaker blocks. Just as you can use FVGs for lower timeframe entries, they are just as useful for aiding in HTF buy, so are directional predictions as points of interest. The basics of FVG translate into various other PD arrays, so it's crucial to understand. We can use an advanced gap theory for further analysis to predict market environments and more. I hope you learned something from this video. Give this video a thumbs up and subscribe for more education like this. Maybe it encourages you to conduct some of your own investigations into how the fair value gap concept can improve your trading. If I've missed any key things from this presentation, please add your findings or understandings in the comments below. Thank you for watching. For more information, we have a free Discord community where we post useful resources and guidance related to questions can be answered. Take care.